Right now in Canada, everyone is asking the same question. What's happening with interest rates? After years of sharp increases, the Bank of Canada finally started cutting. Today, the policy rate sits at 2.75%, and markets are buzzing about what's happening next. Some economists are predicting another 25 basis point cut at the bank's September 2025 meeting, which could bring policies rates down to 2.5%. Now, on paper, that might not sound like a lot, but interest rates are the lever that controls almost everything in housing. When they rise, borrowing cost goes up, affordability shrinks, and housing demand cools. When they fall, borrowing gets cheaper, buyers flood back into the market, and prices usually climb. If you're a homeowner or a buyer, you're probably wondering, is now the time to make a move? Should I wait for the lower rates? Should I lock into a fixed or gamble on a variable? Here's the truth. Nobody has a crystal ball. Rate speculation is just that. It's speculation. But the way you prepare for it, the way you position yourself today, is what determines whether you will win or lose when those changes actually hit. In this video, I want to break down exactly what's happening with interest rates right now, what a potential cut could mean for mortgages, and the steps you can take to protect yourself and maybe even take advantage of the opportunity before everyone else does. Because here's the thing, when rates fall, demand jumps. If you're ready before that wave hits, you'll be in a position to ride it. If you're not, you'll be stuck competing with everyone else who's waited for certainty. The Bank of Canada sets its overnight rate policy. Right now, that's 2.75%. That rate influences everything. The prime rate, which is currently at 4.95%, your variable mortgage rate, and even where the bank sets their fixed rates, which are tied to bond yields. So when people say they expect rate cuts, even a small one, it matters. A drop from 2.75% to 2.5% could mean lower variable rate mortgages, lower HELOC rates, and depending on the bond market, more competitive fixed rates as well. But here's the problem. Rate speculation is a double-edged sword. On one side, lower rates improve affordability. On the other, they trigger demand. If rates fall, buyers sitting on the sidelines will rush back in, and competition will heat up. That could actually push home prices higher again, even as borrowing costs fall. So as a buyer or a homeowner, you're stuck in this tension. Do you wait for the lower rate or do you move now before the crowd comes back? Let's break down the practical steps that you can take to navigate this uncertainty. Step number one, understand variable versus fixed in this market. If you're in a variable rate mortgage, you're the first to benefit from cuts. A 25 basis point drop could mean $50 to $100 a month, depending on your balance. If we see multiple cuts over the next year, those savings compound. But variable also means exposure. If inflation surprises or if global markets shift, the bank could pause or even reverse the cuts. Fixed rates, on the other hand, buy you certainty. If you lock in now, you might pay a little bit more today, but you won't have to worry about rate volatility. So the decision comes down to your risk tolerance. If you can handle some fluctuation, variable gives you flexibility. If stability matters more, fixed may give you the peace of mind. Step number two, get pre-approved before the cut. This is one of the smartest moves that you can make right now. Pre-approval doesn't just give you a budget, it locks in today's rate for 90 to 120 days. And here's why this matters. If rates fall, you can take advantage of the lower rate anyways. But if rates rise unexpectedly, your pre-approval protects you. Think of it as rate insurance. In a market full of uncertainty, that insurance is gold. Number three, watch bond yields like a hawk. Most Canadians don't realize this, but fixed rate mortgages aren't set by the Bank of Canada. They're tied to the bond yields. When bond yields drop, banks lower interest rates. When bond yields rise, fixed rates will follow. So if you're trying to time fixed rate mortgages, watch the bond market trends. It's not perfect, but it's the best leading indicator you've got. Step number four, play the housing demand cycle. Remember, rates don't just affect borrowing costs, they affect demand. Right now, with rates still relatively low, demand is subdued. But if the bank cuts and affordability improves even slightly, you'll see more buyers jump back into the market. That means the best deals may actually be before the next rate cut. Sellers are still nervous, listings are sitting, and you can negotiate. After the cut, competition can come back, negotiating power shifts away from buyers. So think carefully. Do you want the absolute lowest rate, or do you want the best deal on a house? Sometimes those two aren't the same. Step number 5 is plan for the long game. Whether rates go down 25 basis points or even 50, the big picture is that Canada's mortgage market is stabilizing. We're not likely going to go back to the 1.5% mortgage rates that we saw in 2020. But we're also moving away from the peak stresses of 2023. So don't gamble on short-term moves. Instead, build a strategy that works whether your rate is 4.8 or 5.2%. That might mean adjusting your budget, consolidating debt, or setting aside buffers in case payments rise again. Because the families who survive rate cycles aren't the ones who time it perfectly. They're the ones who prepare for flexibility. So what does all of this mean in practice? It means you need to stop waiting for certainty. Rates may drop in September, they may not. But the way you prepare today by getting pre-approved, understanding your options, and targeting opportunities in a quieter market is what will decide whether you win when the cuts do come. So let's wrap this up. The Bank of Canada's policy rate is sitting at 2.75%, and the markets expect to fall to 2.5% in coming months. That's good news for borrowers, but it's also a signal that competition in the housing market will heat up again. If you're a homeowner with a variable rate mortgage, this could mean real savings. If you're on a fixed, it could mean better options when you renew. And if you're a buyer, it means the window you're in right now with softer demand and nervous sellers may not last long. So here's your action plan. Understand variable versus fixed. Know which strategy matches your risk tolerance. Get pre-approved. Lock in protection now and give yourself flexibility later. Watch bond yields. They'll tell you where fixed rates are headed. Plan the cycle. Don't just wait for cuts. Consider acting before the demand wave hits. Think long term. Build a plan that works across different rate environments. Do these 5 things and you'll be in control of your mortgage strategy instead of letting the market control you. Because here's the truth. Interest rates will rise, they will fall, and they will rise again. You can't predict every move, but you can prepare for every outcome. And if you want to look at exactly how these potential rate cuts affect your personal mortgage, whether you're renewing, refinancing, or buying for the first time, I've linked a link to my calendar below. Book a call and let's run the numbers together. Because in a market full of speculation, the best strategy isn't a guess, it's being prepared. I'm Justin Chausse, I'm here to help, and I look forward to seeing you in the next video.